On May 11th, the market faced a new software question. If a fund built around concentrated winners cuts Microsoft to a tiny position, is that just portfolio housekeeping, or is it a warning about software moats?
The outside anchor is TCI Fund Management. Reports say Christopher Hahn's fund cut Microsoft from roughly 10% of its portfolio to about 1% by the end of March. AI was cited as a long-term risk to Office and parts of Azure. That does not prove Microsoft is broken, but it does move the debate from hype to moat durability.
The argument is simple. If users start asking an AI agent to do the work, the app underneath can lose its direct relationship with the customer. Microsoft is still a giant business, but users may care less about which suite is sitting behind the AI layer.
The real test is switching costs. Excel files, Word documents, bundles, and admin controls all helped build the old software moat. If AI makes moving work between tools easier, the moat may not disappear overnight, but it gets tested in a new way.
That is what makes the day tricky. The Microsoft story sounded defensive, but the broader market was still willing to chase risk. Texas Roadhouse gave the other side of the split. Its Q1 release showed 12.8% revenue growth and 7.1% comparable restaurant sales. Investors were still rewarding select consumer strength while asking harder questions about old software favorites. Optical hardware had a clear calendar catalyst. NASDAQ announced that Lumentum will join the NASDAQ 100 before the open on May 18th, replacing CoStar. That does not guarantee a straight-line move, but it gives traders a real index inclusion date in the optical hardware lane.
The optical trade also shows where the AI infrastructure story is moving. The bottleneck is no longer just GPUs. Data movement, optical modules, and server-to-server connections are becoming part of the trade. That is a different story from simply saying chips are strong again.
Breadth was the warning label. The rally may have looked strong at the index level, but leadership was still concentrated in semiconductors and a small group of tech names. That is not a crash call. It is a warning that the market has less room for error if participation does not broaden. Fed policy also moved back onto the watch list. Reuters reported that Kevin Warsh cleared a procedural hurdle on May 11th toward becoming Fed chair. For markets, the issue is balance sheet policy. Would a Warsh-led Fed keep shrinking liquidity even while rate cut pressure stays in the conversation? China also belongs on the watch list, but carefully. Reports say Trump is heading to China this week with more than a dozen executives, including Boeing CEO. That puts aviation headlines in play. I would not treat the rumored 500 plane order as the base case unless a real announcement lands. For traders, the tactical note came from zero DTE options. The warning was that gamma risk can get much nastier after 2 p.m. Eastern, while the reward for holding late can shrink. If you are trading that lane, the message is simple. Size down, know the clock, and do not confuse a morning setup with an all-day trade.
Berkshire gave the opposite signal. Recent reports put its cash pile near a record $397 billion. However you value the portfolio, that much cash says something about discipline and how hard it is to deploy huge capital when markets are already expensive.
So the week starts with a moat test. Microsoft is still Microsoft, but the question has changed. Can old software moats hold when AI starts owning more of the workflow? Watch Microsoft, Lumentum, Breadth, Warsh headlines, and the China trip. The market is still chasing risk, but it is getting pickier about which risks deserve a premium.